Today's video is going to consist of what I just bought into my main portfolio. I'm going to go through why I bought it, why I think it's probably a little undervalued at the moment, how I think it might do quite well as the vaccine rolls out and things get back to normal, and it's got a huge 15% dividend yield at the moment. Yes, welcome back to another video, and first of all, before we go any further, I said that I'd have some sort of awkward haircut. I don't think it's too bad. You can be the judge. Put down in the comments what you think of the haircut, and you can absolutely slate me for it if you want. I didn't take off too much because I had to go to work 2 days later and I am still at work meeting clients. So it was a bit of a risky move, but I've done it. It didn't look too bad. And actually, the fiance did the back, and I was quite pleasantly surprised at how well she did it. So anyway, you're not here to see my hair by any means. I bought another stock. It's gone into my main portfolio. Today I'm going to give you a rundown of why I've bought into it, my thoughts on the stock and its potential recovery process, the yield, and how we value this particular stock. I'll tell you now, it is a REIT, and we value REITs in a slightly different way to the normal PE ratios and things like that. With PE ratios, you take depreciation into account. This is a REIT, and the vast majority of what a REIT invests in is property, which actually more often than not appreciates in value. So actually you factor that in when you're valuing a REIT, and actually you go via funds from operation or adjusted funds from operation rather than a PE ratio. So we're going to look at the funds from operation and the price of funds from operation for this particular REIT, which is incredibly low compared to the average, which is around 16.3 at the moment for most REITs. This is running at about 4.8, so it is hugely undervalued. And I think as things get back to normal and vaccines come out, this particular REIT might start growing again, and the revenues will soon come back in. It's also a sin stock, so we are profiting from things that some people might find uneasy about profiting from. So bear that in mind as well. You may already know what I'm going into. I do also already own this REIT. So I'm averaging down, dollar cost averaging, but it's a good one to be getting into at the moment in my eyes. If you're new to the channel and you want more content just like this, which I'm sure you do, then don't forget to subscribe to the channel. It's very much appreciated, and give the video a like while you're down there if you enjoy the content, or as we go through the video and you're enjoying the content more and more, then give it a like once you've realized that you do actually like the content. We'll move as always into the computer because it's a bit easier. I'll give you a transparent look at the portfolio to start with, and then we'll start looking at some metrics that we use to value this particular company, and I'll tell you exactly what the company is. Stick to the end though. You don't have to stick to the end. I've got nothing else to give you. I'll give you the company in a second and then you can go. Right, opening up as always with the portfolio, complete transparent look at the portfolio. As of today, 51,621, 22, 23, 24 pounds in there. It is the 12th of January, just to give you some perspective. Just received 2 lots of dividend payments, which is good, which has taken my free funds from £220 to 247, so I'll be reinvesting those soon. Another thing I quickly want to look at as well and just steer you guys towards, I've mentioned before, trading with CJ. He's got a Discord. I'll give you a quick sneak peek at it. Here it is, his Discord here. So you get yourself onto his channel and go to his Discord. He's starting to build a pretty good community there, and they talk everything penny stocks, EV stocks, long plays, other side hustle, anything stock and stock market related. So get yourself onto there and have a little butchers at that. So the keen-eyed viewers amongst you will see what I've already got up in one of the tabs at the top. You'll also know that Seeking Alpha is my preferred go-to website for stock analysis. So the stock, yes, is the Geo Group. It is a REIT, as I explained out there. The Geo Group is a REIT that focuses, people consider it a sin stock because it focuses on private prisons, immigration and border detention facilities, rehabilitation facilities, and actually, although the basic description for it, real estate investment trust for private prisons and mental health facilities, but actually it's far more than that. So if we go into the website here, we've got a lot of different things they do about us. They design, build, finance and lease private prison facilities. They do management operations within those facilities, in custody programs, so they do rehabilitation programs for people inside the prisons. They also do recovery and rehabilitation programs for people that are now outside the facilities. So they do ongoing care for visitors or post visitors to those facilities, I guess. Residential re-entry, so re-entry people into the community and things like that, and they do a lot of care programs related to that, and they have a massive electronic monitoring program as well, which they've not too long ago, 2017, I think they bought out one of the biggest companies that deal with electronic monitoring and tax and things like that. So that's just a brief overview of the Geo Group. I'm not going to go into it in a great deal of detail. Now what we're going to do with Geo Group is we're going to focus on the funds from operation as a metric. Now the reason we do that for REITs as opposed to normal companies, I'll quickly explain one way and one metric of valuing a company, or certainly one way of incorporating an equation into valuing then a company, is you'd use EBITDA. I don't know why people try and pronounce that. I don't know why they don't just say EBITDA. Anyway, it's earnings before interest, tax, depreciation and amortization. Now, including that obviously is depreciation and amortization. And what you get with a normal company is not necessarily assets, but things that depreciate in value. Equipment, computers, a fleet of cars, trucks, lorries, transport, anything like that will always depreciate in value. It's not going to be worth what you once bought it for. When calculating one's net worth, you don't take your brand new $60,000 car into account, because it's no longer a $60,000 car. It's now a $30,000 car, maybe 40. So you're always going to have to take depreciation into account, or not include it at all. Now, when valuing a company and their assets, equipment and bits and pieces like that, which aren't actually assets, they're liabilities, who go down that route, if you read Robert Kiyosaki's Rich Dad Poor Dad, you'd have to take that out of the overall sum, which is why EBITDA is earnings before interest is taken off, tax is taken off, depreciation is taken off, and it all has to be worked into the books. It has to be worked into the financial statements, quarterly and yearly financial statements. You have to incorporate depreciation because you have to get an overall net worth of the company. And that's how you value a company. However, REITs are a little bit different in the sense that the vast majority of stuff they own is real estate, is property. And nine times out of 10, a property will go up in value. So let me show you how you work out the funds from operation. That's the metric you'd use instead. So hopefully you can see this. I've got this great little graph that I found. Basically what you take is you take earnings, you take your net income, your depreciation and amortization would be added on. I'll quickly run you through gains from sale of assets. So obviously REITs will quite often buy and sell and trade their assets, which is property, which typically go up in value. So if you buy something at 100 million and it goes up to 150 million over the course of time, the company is therefore taking, in that particular year, would have earned an extra 50 million just in the sale of that asset. They don't include that in this metric. They take it off the top end. And the reason they do that is because REITs typically will hold on to their properties for years and years and years, and then suddenly may sell a few things. Now it's not consistent. It's not consistent enough to keep it in the financials on a yearly basis. You can't just suddenly, oh, we made an extra 50 million this year just because we sold a property. It's not consistent with genuinely what the company is actually earning on a consistent basis, and it's not normal. It's not something that can be relied on. So they take that out. So the gain of the sale of a property, you'd imagine, is an income. It is an income, but they're only going to reallocate it. So net income minus any gains of the sale of assets throughout that time period, plus depreciation, because you don't take depreciation into account, and in actual fact it's probably the opposite. Well, the gain on the sale of assets is actually the opposite, but again you take that off because it's not consistent. But depreciation you don't include, amortization you don't include, and then that's what you end up with. That is the funds from operation. So you've got your net income, take your gains from sale of assets plus your depreciation and amortization, and that's where you get your funds from operation. Okay, so that's the reason we value REITs in a slightly different way. If you did the normal earnings per share or price to earnings ratio, you're not going to get as accurate figure. They're not the worst metrics to go by, but this will give you a more accurate idea of genuinely what the company is bringing in, because they're not having to take depreciation into account. So I hope that made sense. That graph is I found quite useful, and I thought would be good to show you guys. So I'll run you through this one as well. This again might be more helpful for some people to see it in this format. So we've got residential REIT, which is XYZ. We've got net income plus depreciation. So they've worked it in a different way, minus the gain of any sale of a property. So they gain 300,000 in sale of properties, but we don't include that in the balance sheet because it's not consistent. Add other miscellaneous depreciation items and gains, and that is your funds from operation. Okay, adjusted funds from operation, which a lot of people feel is more appropriate to go by, because again you've still got outlays, is capital expenditures. Capital expenditures is basically work you might need to do to a property to then get it rented out. If you own a massive commercial unit, you're in a REIT that does commercial, you've got a huge commercial unit and one tenant moves out and the next company's coming in to take over, you're going to have to probably do some work in the interim to get it ready to be tenanted. So that's your capital expenditures effectively. So adjusted funds from operation, a lot of investors prefer to go by that figure because it's more accurate, but for today I'm just going to be looking at funds from operation. So that's another little breakdown, and this is Investopedia, so you can go onto this and it gives you an idea, a breakdown of how you value it, if you want to have a look at that one, if that's more helpful to you. Now if we go back to Geo Group, we've got a price from funds for operation of 4.59. Now 4.59 is very, very low. I got one figure, I found something online, it's very difficult to find an average and what a REIT should be at. I found a figure online that was 16.3, as I may have mentioned out there. It's actually not the case, that was too far back, that was a report from late 2019, but I have got it here. So in the REIT notes, the average price to normalized FFO tracked for 25 US REITs across multiple real estate sectors was 12.9. Now the average for price to funds from operation being around 12 or just over 12.9 of the 25 REITs that they've averaged it across. Even if you took that down, you thought, well, actually let's go, instead of 12, let's go 10 as an average, and that's really what I want to be looking at. I want to be looking at REITs that have got between 8 and 10 as a price to funds from operation. Now, you know, we've got 4.59, so that's why I'm considering it relatively underpriced. I also believe that as the world starts opening up again and we start traveling more, your borders are going to start opening again, and then of course, and this sounds terrible, but you've got border control and immigration detention facilities that the Geo Group run and manage and have many contracts with all over the world really. So these are going to really benefit the opening up of the world again, and travel again is really going to benefit the Geo Group. It's going to aid in bumping their revenue back up. So do we want to be profiting off things like that? Well, look, if you know, it doesn't bother me, might bother some people, but as the world starts opening up, these detention facilities, border control and immigration and things like that, certainly in the US, it's going to have a real impact on the need for the Geo Group, and their revenues should mirror that. Just to give you an idea, price to funds from operation is calculated, effectively you take the market cap, which at the moment is 1.03 billion, and you divide it by the funds from operation, which I think for the Geo Group for the end of the year was just shy of 300 million. I think we're looking at about 280 million. I can't remember what it was, but it works out to be, that is how you get that kind of figure. So effectively, for its market cap of $1 billion to be making in excess of a $250 million on a yearly basis, funds from operation, it is very, very good, making lots and lots of money. The market cap is still relatively low comparative to what it's making, and that's why the price to funds from operation is coming out so low at 4.59. So I think there's a way to go. I think as we start opening up, the revenue will start to come back, and as it stands, we've got a 15.78% yield. So let's take that yield quickly and I'll run it into a compound interest calculator. So I've already got the figures in actually. I worked it out on a basis that your starting balance is zero. Over the course of 30 years, you invest $200. I hope you can see that, $200 on a monthly basis. So keep putting that into, let's go 15.78. Let's be really pedantic about it. Starting balance is 200. 15.78% on a yearly basis, which is the Geo Group's dividend, which it won't stay at that. Again, I'm not saying this is what it's going to stay at. You'll get 15.78% year round. This is just an exercise to illustrate the power of higher dividend paying companies, and actually your income plays could really benefit from this. Your income plays being maybe just closed-end funds that are offering 8, 9, 12% yields, dividend yields. So I'm compounding it quarterly, and we're putting $200 a month into this, and that comes out at a figure of 1.626 million. So actually we don't even need to do it for that long. I wonder what happens if we just do it for 25 years. Let's do that as an example. There we go, that shows you the power of compounding. If you did this literally just for another 5 years, you are more than doubling your output. So in just 25 years, if you put $200 a month into it, which is not a lot of money for the majority of people, you'll end up with just shy of $750,000. If you then did that for another 2 years, let's say 2 years more, you get yourself your $1 million. So for 27 years, $200 a month into something that's returning 15.78, and you're not going to get that, as I said, you're not going to get 15.78 on a regular basis, but that just gives you, just to illustrate the point of the power of compounding and compound interest in high dividend companies. Now going back to the Seeking Alpha homepage, we've had the stock up at $17, $17, and we're down at just under 9. So I do think there's room for growth. In fact, the 52-week average, we're at the lower end of the 52-week average, and I think we're getting in my eyes, I truly believe, closer to the bottom now. I think, you know, with everything opening up, the only way really is up for the Geo Group. Don't take my word for it, that's what I genuinely believe. So there's an overview of what I've put into the portfolio. For the Geo Group, I now have 106 shares, of which the value is currently $935, and I'm 6.45% down. So I've averaged my cost to $9.43 per share. So can I see this coming back up over the $10 a share mark? Absolutely. And I'll just sit and take that 15% return moving forward. That would be very nice indeed. The Geo Group. So that's it for today, guys. Hope you liked the video. Just a complete transparent look at the portfolio and what I'm buying into, as always, as I'll always do, as I've always said. So I'll leave it there for today. Subscribe to the channel if you haven't already and you're enjoying the content and you want more content, because if you subscribe, you'll see the content come up. And like the video if you have enjoyed it. If you made it this far, you clearly have enjoyed it, so give it a little like down below. That'd be very much appreciated, and we'll catch you guys in the next video. See you later. Bye.